On July 28th, 2025, the U.S. stock market found itself at a crossroads, with major indexes sending mixed signals. The Dow Jones Industrial Average was hovering near record highs, while the S&P 500 Nasdaq showed signs of hesitation. Although this performance might appear strong on the surface, beneath it lay a deeper sense of caution among investors. Volatility crept into the markets as participants attempted to digest a flurry of developments, from international trade shifts to the looming Federal Reserve meeting. The result was a choppy, indecisive trading day that reflected more uncertainty than confidence. Before we dive in, don't forget to like, subscribe, and turn on notifications so you never miss a market update that actually explains what's going on behind the headlines. One of the major forces shaping this market turbulence was the newly announced trade agreement between the United States and the European Union. While the deal initially lifted sentiment, the details revealed a more complex picture. A 15% tariff on most EU goods surprised some analysts, leading investors to reevaluate which sectors might be impacted the most. Although the agreement was positioned as progress on trade relations, its immediate consequences left market participants divided. European stocks, which initially rallied on the news, also faded by market close, further signaling unease about how favorable the deal really was. At the same time, bond markets weren't offering much clarity either. The 10-year U.S. Treasury yield moved in a tight and uneven range, a clear indication that investors were in wait-and-see mode. This defensive posture was largely driven by anticipation surrounding the Federal Reserve's upcoming policy decision. With no rate hike expected in this meeting, focus has shifted to the Fed's tone, its economic outlook, and any subtle shifts in forward guidance that could hint at possible rate cuts later in the year. Even minor changes in language from the Fed could ignite major market moves, a risk many were unwilling to take just yet. This week in particular is what some analysts are calling a monster week for financial markets. It's packed with catalysts. Quarterly earnings reports from major tech players like Microsoft and Meta Platforms, the Federal Reserve's interest rate decision, and key data on labor markets and inflation. With so many high-stakes events unfolding simultaneously, investors are understandably cautious. The sheer volume of information, much of it with the power to move markets dramatically, creates a fog of uncertainty, making it difficult for traders to commit strongly in either direction. Adding further complexity is the fallout from the U.S. EU trade deal and an approaching deadline on August 1st for additional trade agreements. While the current deal was seen as avoiding a worst-case scenario, the tariffs introduced are still steeper than many had anticipated. These could influence both corporate profit margins and inflationary trends in the coming months. Investors are now trying to determine whether the trade deal is a short-term headwind or a longer-term threat to global supply chains and pricing power. Until more clarity emerges, risk appetite is likely to remain subdued. Recent economic data hasn't helped to ease the tension. Indicators have been sending mixed messages. A strong jobs report in June showed higher than expected employment gains, but a closer look revealed weaker private sector hiring and a drop in labor force participation. These conflicting signals have left investors grappling with two competing narratives, one suggesting economic resilience and another pointing to potential softness beneath the surface. With so much at stake, even data points that might otherwise be brushed off are now under intense scrutiny. Valuation concerns are also beginning to creep back into the conversation. After a multi-week rally that pushed stocks to fresh highs, some analysts believe that current prices may have outpaced underlying fundamentals. This has made markets more vulnerable to short-term swings and increased the likelihood of sudden sell-offs if any news disappoints. Investors who were once riding the bullish wave are now taking a more defensive stance, locking in profits and becoming highly reactive to headlines, further adding to the choppiness. The market's indecisiveness on July 28, 2025, is no mystery when placed against this backdrop of overlapping pressures. Between trade negotiations, Fed uncertainty, unpredictable economic data, and stretched valuations, the ingredients for volatility are all in place. While the Dow may be flirting with record highs, the overall mood remains cautious. It's a market waiting for direction, And with so many pivotal events unfolding at once, the path forward will likely be shaped not just by what happens, but by how markets interpret it. If you found this breakdown helpful, smash that like button, drop a comment with your market take, and subscribe for real-time analysis that keeps you ahead of the curve. Your support fuels deeper dives like this one.